Hey guys, welcome back to the channel. So because you've been asking for it in the comments, today I'm going to be analysing Rakesh Jhunjhunwala's legendary bet in Titan to see if we can take some lessons to help us find our own compounders in the present time. If you haven't heard of Rakesh's legendary investing career, then make sure you check out my recent video, which was sort of an introduction to his investing style. Now, I had a few comments in the last video saying that Rakesh made a lot of money in other ways, including some insider trading. And while that may be true, it's not really what I'm interested in. Ultimately, Rakesh bought Titan, and then the stock went up more than 600-fold. So what I'm interested in personally is finding out why Rakesh bought Titan and what he saw in the company by analysing Titan back in 2001. So that's the topic for today's video, and let's get into it. Now, I know Google says that Rakesh first bought Titan in 2002, but in Titan's 2002 annual report, it said Rakesh was already one of Titan's largest shareholders. So that's why I'll be looking backwards from 2001, as that's the report he probably would have been looking at. So in 2001, Titan was made up of two business segments, the watch segment and the jewellery segment. The watch business was Titan's main segment, and it was the company's core business when it was founded, whereas the jewellery division was more of a recent segment that they created to generate much needed foreign currency. And that decision had massive implications for the company, both in the short term and in the years following, and you'll see what I mean when we look at the company's financials. So first things first, I just want to praise Titan for having such in-depth financials, which go all the way back to the 1980s when the company was founded. I wish every company did this, because it makes it so easy to look at each segment's performance over long periods of time. Alright, if we look at some of Titan's business segments over the years, their watch segment, which is measured in volume of watches sold, had a compounded annual growth rate of 26% a year over 13 years. And every year since their inception, they managed to sell more watches than the previous year, which is very impressive. Even more impressive is their jewellery division, which had a staggering growth rate of 108% a year since it was established in 1994. For their overall revenue, Titan's revenue compounded by around 33% a year over 13 years. And finally, if we look at Titan's profit after tax, it also had an insane growth rate of 41% a year, which shows Titan were becoming more profitable over time, probably due to operating efficiencies, which management talk about extensively in the annual report. Which brings me to the next section. As Warren Buffett always says, looking at the profits or the growth in profits is pretty meaningless without looking at the capital required to achieve that growth. And this is where it gets a little tricky for Titan. So with this spreadsheet, long-time subscribers will know what's going on. But for the people who are new, this is a spreadsheet I use quite a lot on the channel to try assess a company's quality by looking at their return on capital, the return on incremental capital, and the reinvestment rate. And I usually look at both the long term and the short term. If you're interested, I made a full video where I explain all this in detail. So if you want, watch that video first. Otherwise keep watching and I'll explain as I go through. So if we look at the 10-year period, I have Titan's profit after tax for 1991 and 2001. And then the difference between the two figures on the right. This difference is the incremental earnings. Next, I have the total capital employed, which you can see is total assets minus current liabilities. And again, the difference on the right is the incremental capital. So first things first, if we look at Titan's overall return on capital employed, which is the current earnings divided by the current capital, it looks like a pretty low return business at first glance, and I'll come back around to this in a minute. Next, if we look at Titan's return on incremental capital, which is the incremental earnings divided by the incremental capital, it's even worse at less than 3%. So let's break down why. Now, Titan's profits were a bit all over the place during this time, but essentially, Titan tripled their profits over 10 years from 1.1 million to 2.8 million. But to achieve that growth, Titan had to use 15 times more capital within the business. So there's two ways to look at this. Number one, Titan required all of this new capital to grow its earnings, and it's a low return, extremely capital intensive business. Or number two, Titan didn't need all of this new capital to grow its earnings, and a percentage of this incremental capital is essentially an investment that will pay returns sometime in the future. Now, I think knowing which one it is for any business requires one to have a deep understanding of that company, which was definitely the case with Rakesh and Titan. Thankfully, because I have the courtesy of knowing how the next 10 years turned out for Titan, just a quick look at their later reports showed that Titan did indeed become a very high quality business that generated exceptional returns on capital employed. And the million-dollar question is, was this knowable in advance back in 2001? I think the answer is yes. Now, even though Titan is a business that doesn't really fall in my circle of competence, and it would have gone in the too hard pile as Buffett would say, for the sake of this case study, I'll imagine it is a business I understand. And based on everything I just looked at, let's assume I'm intrigued enough to look deeper at Titan's reports to see if it's option 1 or option 2. I think one of the best ways to find out, apart from understanding the business, is going through the company's annual reports and reading what the management have to say about the company. And similar to how Bezos spoke in the Amazon letters back in the early 2000s, you want it to be plain and obvious that the company is reinvesting capital that is yet to show returns, but will show significant returns in the future. So when I went through Titan's annual reports, although it's not as plain spoken as Bezos, the management do give a huge amount of insight into the company and its individual segments. And I think if you had a lot of insight into the watch and jewellery market in India, like Rakesh, you would have been able to read between the lines and see that Titan was reinvesting a lot of capital that was yet to show returns. The first key point is that according to management, the wristwatch market in India hasn't even reached its full potential. They say the Indian wristwatch market is estimated to be the order of 25 million watches a year, in which your company is the leader in market share and stature. However, the average annual sale of watches, at 25 per thousand of the population, is far below the world average, which is over 100 watches per thousand. Consequently, the total population of watches in this country is less than 200 million, which means there's tremendous potential for the sale of watches in India, with its population of over 1 billion. So Titan's watch business, which was their main segment at the time, had a lot of room to grow and hadn't come close to its maximum potential. The main point though, which definitely would have required some deep knowledge of the market to foresee, was Titan's investments into the jewellery business, which had a massive runway to grow. In Titan's report, they say that the total capital employed within the jewellery business was around 154 crores, which was a large percentage of their total capital employed of around 500 crores. But the jewellery segment at the time only made around 2 crores in profits. So at this point, there was a lot of capital being deployed for not much return, but this wasn't to be the case for long. By the end of the decade, the jewellery segment was generating 3 times the revenue of the watch segment, and according to management, generated a staggering 80% return on capital employed. Now, whether that was knowable in advance, I'm not sure, but I do think it was clear back in 2001 that there was a lot of capital being invested in the jewellery segment, which wasn't producing much return, but it had a fairly high probability of paying decent returns in the future because of Titan's moat. As Monish Pabrai says, the nature of capitalism is when a company is generating above average returns, like Titan was by the end of the decade. In order for a business to keep generating high returns on capital, it must have some sort of durable competitive advantage, also known as a moat. Otherwise, a business will have its excess returns competed away over time by competitors. And back in 2001, Titan had one of the best moats there is, a strong brand moat with a reputation for quality and trust. In Titan's report, the management said, "One of the biggest assets of your company, not reflected on the balance sheet, remains the Titan brand," and then go on to mention how they've been voted most admired company many times in the last few years. They also mention how their brand name and reputation for quality allowed them to gain a strong foothold in the jewellery business, as the jewellery market in India was very fragmented and lacked professionalism. And the management thought they had an opportunity to bring the industry a high degree of professionalism, ethical practices, innovation, and consistent high quality. And this led to their jewellery brand Tanishq becoming India's preeminent national fine jewellery brand, setting the standards with the quality of its products. So overall, if you combine the fact that Titan's total capital employed was returning much less than its potential, with Titan's wide moat, and also the length of the runway for both of their business segments, then Titan definitely looked interesting back in 2001, as long as you had a good understanding of the business. There are cons too, of course, like Titan's huge amount of debt, but overall I think Titan was a high quality business with a great culture, and it had the potential to be a high return business in the future, with a wide moat around the company to protect those high returns. So the last question, as always when making an investment, is the price, and unfortunately I couldn't find any information on Titan's market cap back in 2001, but based on what I've read in articles about Rakesh's investment, Titan was very cheap at the time, and I'm guessing that was because of their large amount of debt and the reported financials showing low returns on capital employed. I believe he may have even bought Titan for less than its book value at the time, so he essentially bought a high quality compounder for cents on the dollar. So that's my analysis for Titan in 2001, and I hope you found it interesting. And if you enjoyed the video, please consider hitting that like button, as it really helps support the channel. As always, if you have any questions, please leave a comment down below. And if you watched the video all the way to the end, thank you so much for watching. And if you want to see the best portfolio tracker out there, then stay tuned for the quick spiel at the end of the video. So that's it for this video. Thank you so much for watching, and I hope to see you guys back in the next one. Hey guys, do you track your portfolio manually in an Excel spreadsheet? If so, you can avoid so much hassle by signing up to ShareSite for free. ShareSite is the portfolio tracking tool that I use to track all my investments. And unlike most brokerages, ShareSite automatically tracks everything including capital gains, dividends, and also currency gains if you invest in foreign markets. It's also completely free to sign up to ShareSite, and you can use it for as long as you like. And if you sign up to a paid plan, then use my referral below, sharesite.com/investingiq, and you'll get 4 months for free when you sign up to an annual plan. So what are you waiting for? Go check out ShareSite.